A recession is a period of economic decline, typically defined as 2 consecutive quarters of negative GDP growth. While recessions can be unpredictable, economists use several key indicators to identify warning signs before they happen. Key indicators of a recession: declining gross domestic product, GDP. GDP measures the total value of goods and services produced in a country. If GDP shrinks for 2 consecutive quarters, it signals a technical recession. Example: in 2008, U.S. GDP contracted, marking the start of the Great Recession. Rising unemployment rate. When businesses struggle, they cut jobs, increasing unemployment. A rising unemployment rate above 5 to 6% suggests economic trouble. Example: the COVID-19 pandemic caused mass layoffs, signaling a recession. Stock market declines. A falling stock market reflects investor fear and economic slowdown. Sharp drops in major indices like the S&P 500 and Dow Jones can indicate trouble ahead. Example: the stock market crashed before the 2008 and 2020 recessions. Inverted yield curve. A normal yield curve means long-term bonds have higher interest rates than short-term bonds. When short-term rates rise above long-term rates, it's called an inverted yield curve, a historical recession predictor. Example: the yield curve inverted in 2019, predicting the 2020 recession. Decreasing consumer spending. Consumer spending drives 70% of the U.S. economy. When people cut back on shopping, travel, and dining, businesses make less money, leading to layoffs and slower growth. Example: high inflation in 2022 reduced household spending, raising recession concerns. Falling business confidence. When businesses expect lower profits, they reduce hiring, cut spending, and delay expansion. Surveys like the ISM Manufacturing Index and the Consumer Confidence Index help track economic sentiment. Example: before the 2008 financial crisis, business confidence hit record lows. High inflation and interest rates. Rising inflation reduces purchasing power, making goods more expensive. Central banks raise interest rates to control inflation, making borrowing expensive and slowing economic activity. Example: in 2023, high interest rates aimed at reducing inflation slowed the housing market. Example of recession indicators in action. In 2007 to 2008, several recession indicators appeared. GDP declined for 2 consecutive quarters. The stock market crashed, wiping out trillions in wealth. Unemployment surged above 10%. The yield curve inverted, signaling economic trouble. All these warning signs led to the Great Recession, the worst economic downturn since the Great Depression. Quick recap. What are recession indicators? Economic signs that warn of a slowdown. Key indicators: declining GDP, rising unemployment, stock market drops, an inverted yield curve, reduced consumer spending, weak business confidence, and high inflation. Why do they matter? Recognizing these signs helps businesses, investors, and policymakers prepare for economic downturns. Understanding recession indicators helps individuals and businesses make better financial decisions, ensuring they're prepared for economic downturns.